Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry Lutz. It is Tuesday, January 13th. Back from a much and well-deserved vacation is Danielle Park. And we'll be talking about what's ahead, what's next for 2015. Danielle, how you doing?
Happy New Year, Kerry. I'm well, thanks.
Good. And batteries are recharged. You're ready for what's ahead, I hope, huh?
Absolutely. Never a dull moment. Jump out of bed every morning at 5:30 and just want to get going. You know, there's so much to do here.
Oh, Lord knows. And so a lot of myths got shattered at the end of 2014, continued to be shattered in 2015, and it's going to be tough sledding ahead for the world economy.
Well, you know, Kerry, it's already been tough sledding ahead for the world economy. Actually, the world economy in our work peaked in its growth cycle in 2011, early in 11. That's when the commodities rebound out of the 2009 collapse peaked and began to decline again. And so we've been tracking the overall economy lower ever since 2011. The myth or mythology was that the ever escalating financial markets were somehow evidence to the contrary of everything else that we saw in the overall economy. And, you know, our client letter at the end of December was just sort of filling out the details on that. But the futures world, you know, the financial futures world, the financialization that went on in the commodities sector, as an example, in the world, really took off with a fevered pitch in 2005 with all the derivatives and subprime underwriting that went on. The financial machine kicked into high drive, and all these companies were trading and selling products based on, you know, underlying commodities, that sort of thing. And that's how the whole derivatives bubble really blew up. And took these commodity prices along for the ride. But what happened was people misunderstood, Kerry, what was driving that. They thought that this was a rebound in global demand and growth. They thought that this was a resurgent China, right, that was buying up all the stuff for its own consumption. What they didn't appreciate was that prices were being manipulated essentially and front run and maintained at lofty levels by these derivative traders. And so we have some charts on that. It's really quite astounding to see, you know, for the whole, if you take oil as a barometer of the world economy, world oil production increased, no question, between 1996 and present, for example. It's a pretty straight green line, you know, escalating over time. But what happened was that the price went berserk in and around 2005. And you see that remarkably. So although the two things between price, production, and demand used to be somewhat in sync, they really disconnected wildly for a few years there. And so the fact that everything's been coming back down since 2011 really just adds support to our argument that QE wasn't a miracle drug. In fact, it distorted financial markets, but did very little for underlying demand and growth, and that we're now slipping back into the correction phase of the business cycle. You know, Canada has been driven, just like the U.S. has been driven primarily from its energy sector over the last few years, and our energy sectors focused in the province of Alberta, and the Canadian Conference Board just recently put out a new report, no surprise, to say that Alberta is very likely entering recession as we speak. And if Alberta's entering recession, Kerry, then Canada's entering recession, because all of our job growth, all of our CapEx, everything that really was a sort of a positive growth story in the past years came from our oil patch.
And it's exactly the same with the U.S. as well, right? I mean, pretty much North Dakota, Texas, Louisiana, Oklahoma. That's really where the big story was in the U.S.
Absolutely.
Yeah,
absolutely. All the bulk of the job creation, certainly all the good job, well-paying jobs just about came from that sector. Again, if you look at the recovery in employment or the reduction in the unemployment rate since the recession of 2008, if you take out the jobs that were created in the oil and gas sector, there was no real meaningful recovery, and the unemployment rate would be much higher than it currently is nationally. And so the problem is, of course, that's exactly what's mean reverting right now. So you're seeing layoffs already beginning to be announced. We're only 7 months from the last peak in oil and gas. It's been declining steadily, although, very quickly, I'll grant you, 3 and 5% a day, it's been clocking on a regular basis here. But the important thing, I think, to appreciate is the pullback and stop the mental anchoring. So I think that people have been conditioned by the bubble conditions, by the financial bubble, to anchor the idea of where valuation should be or prices should be. So they'll say, for example, oil should trade in the $60 to $80 range, or some of these energy companies should, be at a certain level. But actually, if you pull back and look at the impact that took place during the financial derivatives bubble, the QE bubble that I've been talking about here, you see that secular support for these staples of the world economy is significantly lower. And that was sort of a bubble period that when you lop that off, you see that the secular long-term trading range for something like oil was in the $10 to $30 a barrel range, Kerry, not anywhere near 60 to 80. That was a period that is really anomalous in history when you look at it. And so that's just one example. Copper's another one, been coming down painfully slowly because, again, it was part of this great, manipulation trade in the past few years. But now it's too deflating, 3% sort of a day. So I see this as just a recoupling of the world staple, the price of the world's staple goods with the demand and supply, the oversupply that currently exists. And now we turn our attention to, those other growth miracles that people have been hoping would work out, which is the broad market indexes. So the S&P 500, for example, and the TSX in Canada. So you've got all these other sectors rolling over, that the actual ones that drive the economy have been declining towards their 2009 low for the past 4 years. And yet you've got the Canadian financial industry shares and the REITs, which is the real estate market, at nosebleed levels. And those two sectors are really holding up the composite. People think they've got some kind of diversified investment in Canada when they're holding the TSX. In fact, they've got an over-concentration in the two most vulnerable and highly valued sectors.
And it's the same here in the U.S. All of these high-yielding sectors, so many of you put your money in there, and that included the energy sector because historically, let's face it, energy has paid higher dividends and distributions, MLPs, et cetera. Now they're under attack, and you got to expect, Danielle, that they're going to revert to the mean, as you said in the past, which means that they're going to be cutting their dividends, cutting their distributions, because prices are headed down. And looking at your blog, and I saw it elsewhere, you see that retail continues to contract, continues to shrink, and there really is no sign of that, that trend reversing, is there?
No, well, and it makes perfect sense. Again, if we can go back to some kind of common sense assessment of what's going on in the world, you've had this huge buildup, courtesy of the credit bubble, in sectors with discretionary spending. So the retail sector, the real estate sector, the vacation property sector, and people really, when you see that the plunge in oil the past 6 months has already clocked, the earnings expectations of 9 out of 10 sectors in the S&P 500. We're not talking about something that's centric to just energy here. We're talking about something that is broad-based. Some estimates are that there's about 3 workers employed for every oil and gas person working in America today. So you've got feeder sectors, finance, law, many of the service providers. And again, it's not that oil is raining on the parade. It's that global demand is taking its toll. In other words, remember we kept talking about how people had too much debt, they were getting older, their appetite for spending was naturally inclined to fall with age, and then you have all the weight of trying to sustain old spending habits that were prevalent in the credit bubble, and they've been coming back down. So Americans have been slowly, reverting back towards their long-term savings rates. They got more to go, but they're about 7% today versus nearly nil in 2005. Canada's way behind, but the same process is slowly happening here. So all that is happening in other countries too. It's Europe, it's Japan, it's China, all of that. You've got the aging demographic and the weight of the debt. And the two together mean deflation. They mean lower spending, less ability or interest in spending, frankly, and then oversupply in just about everything. So all those things together mean asset deflation is the dominant theme. And although the QEs of the world have tried to fight the weight of that natural tendency, they've just been completely unsuccessful. They've certainly bought more time for the finance sector. They've allowed certain people to gouge profits out of the system a while longer, but ultimately the weight of that thing is just too great for any central banker to offset.
Yep. And we're going to find out very quickly the limitations of central banking, aren't we?
Well, yeah. I mean, if we needed more evidence of it, it's a comedy hour, frankly, when they come out with their press conferences and their confident prognostications about what's coming in the future. They've been completely wrong constantly, every single quarter since the Great Recession and before that, because they thought it was all going to be rosy, even in 2007, with all the writing on the wall about subprime. You've got the default rate picking up in car loans again, Kerry. We were talking about how crazy car loans have been, right, in the past few years, giving everyone and their dog or two cars with no job, who cares, just take it. The latest thing I saw, Kerry, I was thinking about this, was, we've said 0 down, 0 interest, 8, 9, 10, take the car. Now I'm hearing commercial ads for you don't even have to make payments for a long time. Even for 6 months, you don't make a payment. So now it'll be a year of don't. Soon it'll be just, people are literally taking the cars and defaulting as soon as the payments start. That's the latest trend.
You talk about that and real estate and anything to do with credit to uncredit worthy borrowers. I was looking at a house. This woman had bought the house, quote unquote, bought. I mean, it's just pushed at her. It was like an $82,500 house. She put $1,500 down in 2009. This was after the crash. So they gave her $81,000 mortgage. This was in June. By March, she had defaulted on the home, and proceedings had begun. They just got rid of her last month. All right, so she lived in the home, basically rent-free, payment-free from 2010, from March of 2010 to December of 2014, and this is the way of the world when you give people who shouldn't have credit. And
it's the end of a philosophy, right? It's the end of an era. I mean, when you saw Mr. Obama, was it last week, talking about lowering the down payment requirements to 3% again, Kerry? And I thought, oh dear, the bankers are still running the place, right? They literally have to get that, get the grubby hands severed off of the government policy arm somehow. And so far, there's very few people. Janet Yellen said the absolutely ridiculous statement just a couple of months ago that, she was concerned that it was getting to the point where only people with decent credit could afford to buy a house. This is the head of the central bank actually saying that in public and not even catching herself at how ludicrous that statement is. So this obsession with the fact that money should be free and that everything should be obtained without effort or deposit or income or savings, it is, certainly run to the end of any kind of rational model, and it needs to end. People have to go back to realizing that they need to build up money before they buy things. And, it started with the introduction, frankly, of the buying on layaway plan in the 20s, which, was one of the things that led to the crash of 29. It was that incremental increase in spending that was able to happen through that very simple sort of, not even a financing technique, but just a consumption technique on time, that started there and really just went to full nut job in the past few years, burst the housing market in the United States and elsewhere. And then, because they didn't want to give up on that, burst the car loan market, is doing it right now. The high energy debt market, the high yield debt market, they're all imploding because companies borrowed too much and paid too little interest. So this whole concept of free money has really been the bane of our existence. So I'm thinking, when something can't continue, it won't. And ultimately, people will learn to do it a different way. Yeah. Under great pain, of course, but so be it.
Hey, well, people don't change their evil ways unless they're forced to change them. You know that, Danielle, because it just works that way. People don't change unless you're forced to change. And the market has a way of making that change very expensive and very painful, but you have to change nonetheless. And honestly, credit, what is credit? It just allows you to buy things today for which you would have to save and purchase tomorrow. And the other really pernicious effect of credit, Danielle, is it inflates the prices of items that they wind up costing way more than they would otherwise cost. If you don't believe me, cost of a college education, cost of a home, a new home, cost of cost of automobiles. If every automobile was paid for in cash, what do you think the average cost of a new car would be?
Yeah.
You think it would be as high as it is today?
No, it wouldn't. And the other thing is that the reason that we have to go through this period of steep asset deflation is because the credit bubble enabled so much artificial demand, which is now mean reverting. So the world is afloat in things that were produced on the assumption of consumption, which can no longer continue. So all those cars, all those houses, all those malls, all those consumer goods, all those, like I say, vacation properties, things that were all about aspirational, all those golf courses. I mean, it goes on and on and on. It was an epic spending binge. And now we're going to have to look at ways to refit some of this stuff. Literally, I don't know, all the retail space, the office space that's been built that is excess, will have to be retrofit or changed to a different use. And it won't be easy to figure that out because we've got so much excess supply in pretty much every structure that is known to mankind today. So, listen, this is bad if you're working somewhere and you're about to lose your job because of the downsizing that's happening. I get it. It's not happy to think that you thought your assets were worth X and in fact they're going to be worth substantially less than that. But on the other hand, the cleansing process needs to happen, and once it does, we can reboot and restart in a better direction. So I say let's just accept the facts and move forward. If you're holding a bunch of equity exposure today or high yield debt today, you're likely to get your clock cleaned again. And if that happens to you for the third time in 15 years, then I'm afraid that you've earned it. It's not a nice thing to say, but how many times do you need to go through this experience before the penny finally drops? And if you're over levered in real estate today, it's likely to go very badly for you. The Alberta government's still not saying that they see a recession, but anybody with a brain can see that there's a recession coming in these areas. The federal government's budget in Canada, as I say, just flipped to deficit. The Conservatives were certain they were going to have a surplus. Politicians don't ever see this coming, so you can't wait until they warn about any of it. You have to really take some, as I say, common sense approach to your own life. live within your means, pay down your debt, build up your savings, don't buy everything under the sun. And if you have liquidity, then wait, because there's some great opportunity coming. Those who have liquidity and the money to buy things will be able to pick stuff up really cheap, probably cheaper than you can imagine today.
Yeah, that's the thing. So you see a contraction in the world's stock exchanges also coming on their way, right? It's inevitable, isn't it?
Yeah. You can overlay a chart of the price of oil with the chart of financial derivatives, with the chart of high yield debt, with the chart of the consumer credit bubble. It all lines up with the growth story in China. It all lines up. It's the same thing that's driving all of it. And now that fundamental disconnect is recoupling between financial assets and the real economy and actual demand, I think you're going to see the haircuts could be breathtaking. And that's exciting for people that are ready for that. It's bad for pension funds and people who didn't adjust after the last downturn and kept doubling down on the same speculative episodes. But eventually those people have to take their losses, I'm afraid, and then we'll restart. Yeah,
well, hey, this is a cycle. It's not like it's happened for the first time, Danielle, but this is a really serious.
The scope and scale this time, because of credit derivatives, was beyond anything ever seen before.
Yeah, and you can only imagine the billions of dollars being lost because, not all oil companies didn't see this happening. A lot of them have hedged major parts of their production for the better part of a year. And, that's billions and billions of dollars of production that's hedged out. Countries, not so much. So countries will go bankrupt before a lot of companies will go bankrupt. That happens to be the fact of the matter. And you see the countries going bankrupt right now before your very eyes.
Yeah. The only thing I'd say about the hedges is that I don't think that most companies also were cognizant of the extent of decline that was built into the exuberant valuations. So although many the larger ones may have done some prudent things around hedging, I still find that they're talking about a short-term downturn. They still believe that oil is, likely to rebound quickly here to the 60 to 80 range. That's the most common statement I hear. Yeah, so although they think they have enough cash on hand, for example, or they think that they can, downsize a bit now and that things will come roaring back, if this is a secular shift, the way everything seems to suggest, then this is going to be lower for longer than anybody presently thinks likely. And that will be hard for them to adjust sufficiently without cutting a lot of probably workforce, probably operations. And eventually then supply will come down and things will stabilize. But I just think it's going to take longer than some people think.
Yeah, it always does. And like most things, nobody will see it coming. So make sure you take a look at Danielle's blog, jugglingdynamite.com. Sign up for her newsletter. Sign up for our newsletter. Check out our site, financialsurvivalnetwork.com. And we will be talking with you again, Danielle, in a couple of weeks. But man, it's just amazing how quickly it all unraveled. I mean, obviously, it's been building up. You saw it. I saw it to a lesser degree. But, it's just amazing how fast it happened.
Credit works fast on the way up and then 3 times as fast on the way down. That's how it goes.
And we'll remember that. So, and that'll be the headline of this segment on the Financial Survival Network. Danielle, be well. Talk to you soon.
Thanks, Kerry. Bye.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.